Hey, good morning, guys. Welcome to another video. Thank you for being here. Appreciate you being here. On today's video, guys, I want to talk about the 20 common mistakes and how to avoid them in terms of investing. Okay, now, two-part series. This is part one. We're going to talk about the first 10 of the 20. And then next week, we'll talk about the next 10. I didn't want to spend one show, one time doing all 20 of them. We'd be here for several hours. So I just want to spend some time today talking about common investing mistakes that people make a lot. Do me a favor if you can hear me okay. Give me a thumbs up. Let me know you can hear me. And let me know where you're coming from. What city, what state, what country, what county, what you name it. What Milky Way, what planet are you on? Let me know where you're coming from, guys. And we're going to jump in this conversation. And hopefully, it won't be too long of a video. It'll be fairly short, but we just want to get this information out. One of the reasons I'm doing this is because I get a lot of messages from people either through comments or through emails or messages on the website at smartmoneybro.com where people um, they ask me questions, and based on how they ask the questions, I can kind of tell that they're missing a few things to think about when it comes to investing. And then I have these one-on-one conversations with a lot of people, and it comes to fruition that, yeah, people are missing some things about investing. And so I said, okay, let me just do a quick video about it to say, okay, here's what you want to make sure you avoid when you're doing your investing. All right. So as we get rolling, we got Michigan in the house. Thank you, John, Willie Willow. Good to have you here. Greensboro, North Carolina, North Kakalaki. Good. Mexico's here. Philly's in the house. Connecticut's here. Hey, California is here. Yeah, hit the like button as you come in. Karen, what city in Mississippi are you in? Let's see. Western New York, upstate New York is here. Good. Rhonda's in Indiana, and Pistol Pete's in Minneapolis. Good to have you from Minneapolis. Jackson, Mississippi, the capital of Mississippi. Good to have you, Benjamin. Philly suburbs, Grayman, thank you. Mrs. Moore from Atlanta, good. San Antonio's here. Winnipeg, Canada. We got Kansas City in the house. Good to have you. Atlanta's here. So we got folks from all over. Thank you so much for being here, guys. I appreciate it more than you know. Columbus, Ohio is here too. Philly suburbs. William is here. Good, 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 good. So do we have investors in here, or do we have, if you had to choose what level of investing you're at, would you say beginner, middle, middle, is that the right word? Beginner, medium, or experienced? Let me know in the comment section, guys. Beginning, I don't know a good word for middle. Somebody give me a good word for middle. A beginning investor, kind of a middle investor, been around for a while, or super seasoned, you've been doing this for 20 years or 15 years. Let me know in the chat below. I would really would appreciate just trying to get a feel for what level of investor we have in here. We got somebody here from Daleville, Mississippi. Okay, okay, good. All right, Callie's in the house. So we got beginner, beginner. We got mid-level, mid-range. I like that word better. Pete, Pistol Pete. Another beginner. We got a beginner. We got an intermediate. That's a great word for it. Intermediate. We have middle. We have somebody that's seasoned. Good. We got at least a couple seasoned folks, but a lot of beginners and a lot of intermediate. Right. So this is very, very relevant to you guys that are kind of beginning and in the middle, and you're not a 20-year investor or a 30-year investor. This is perfect. You guys are going to really get some good stuff out of this that you can take with you as you begin and get going on your investment tour. Middle, beginner here, good. We got a couple of intermediates and Nigel. So, okay, great, 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 great. Excellent, excellent, excellent. Part one today. Part one today. Nancy in Nebraska. Good to have you, Nancy. Let's see here. Appreciate you guys being here on Facebook as well. So this is part one. Next Saturday, same time, same place, we'll jump into part two, but it's going to be 10 today, 10 next week. And that way we can kind of spread it out and don't throw too much on the plate all at one time. But then you can share this, this couple of series with a couple of people or 3 or 4 people who that are just starting to invest or wanting to invest or thinking about it, talking about it, etc. Right? You can share and bless them with some good, solid investment information. The key is when you're learning how to invest, it's important to learn and then do your own research, your own study, and all that good stuff, right? You learn from good investors, and you learn from bad investors what to do and what not to do, right? But these 20 common mistakes, it's going to give you some things to watch out for, right? And if any of these mistakes sound familiar, you can let me know in the chat. We'll keep the chat rolling. If you got some questions, put a Q in there and we'll roll it like that. So let's jump right into it, guys. By the way, when you come in, hit the like button for me. Just go ahead and tap that, and check out the description box below. There's some stuff down there you can check out, some free stuff as well. So the very first one, and let's jump right into it. The very first one is mistake that you need to avoid, and how to avoid it is expecting too much from your investments right off the bat. Just expecting too much from your investment right off the bat, like having what most people just would call unrealistic expectations, right? Having unreal expectations because you heard something, or somebody said something, or you read a story, a news story, right? Oftentimes people are trying to um, read a news, they look at a news story and they say, "Oh, okay, this is what's happened with this stock. Man, great past performance, right? Wow, okay, this is great." But the problem is that they end up saying, "Okay, that's what happened in the past, but guess what? I'm expecting that to happen in the future." You always have to remember that what happened in the past with a stock is not indicative of what's definitely going to happen in the future. There's no guarantee, right? So if it happened, the last 6 months has saw some incredible gains in a stock. Okay. Doesn't mean the next 6 months are going to see the same gains. You just expect, some people just tend to expect too much from their investments, right? The average stock market return is roughly what? Between 9 and 10%, adjusted for inflation, more like 8%, right? 7.5 to 8%. So you have to keep that in mind when you're investing. Just because over the last 6 months that thing went up, that stock, that company went up by 25%, does not mean it's going to continue to do that, right? So we have to have realistic expectations, right? To create an accurate plan of what you're doing. Right? So you can't expect all these super duper large returns all the time, right? Don't make a company, and we've been talking a lot about Nvidia, but you got to be careful about trying to make Nvidia your litmus test for all the other companies out there, right? And as soon as Nvidia is not shooting up $3 a day and $5 a day, you all of a sudden get discouraged, right? Because you're expecting too much, super large returns. Look, Coca-Cola ain't going to do what Nvidia's doing, right? So don't sort of set the bar for your investments based on the performance of some incredibly high performing uh, AI tech stock, right? Broadcom is killing the game and going up in 6 months, almost, 30% in 6 months. Look, that's very, very rare, right? But what happens is we get to watching these stocks that are leaping up and leaping up, the Nvidias and the Broadcoms and all these stocks, and we say, "Wow, I'm going to buy Best Buy, and it's going to leap up." Like, no, Best Buy won't leap like that, right? That we have to have reasonable expectations for what we invest in. Same goes true. Well, look, we're talking stock market. We're talking, I don't care if you're investing in gold. I don't care if you're investing in art. I don't care if you're investing in real estate. You have to be realistic. I hear people all the time say, "Oh, I bought this house for $300,000, and in 5 years, it's going to be worth $500,000." No, 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 it doesn't go up like that in most places in America. Real estate might have a 3 to 4 to 5% return in good places. But if you buy in the wrong location, your real estate might not go up, but 1% a year, if that. So sometimes when we're investing our money, we get too wrapped up into hype, right? We get too wrapped up in what happened before. We see that real estate went up tremendously in what, 21, 22, 23, really 21, 22, and a little bit 23 also. That's the years 2021, 22. We saw real estate go up. Real estate ain't gonna keep going up like that in 25, 26, 27, 28. Right? It's just not gonna do that. So we have to be realistic. Let's see. Somebody said middle. Okay, boom, boom, boom. So yeah, we got some beginners in here, some middle. Hey, good afternoon to you, Sunset on the Ocean. Focus on the marathon, not the sprint. I like that idea. Thanks, William. Risk management. We'll get to all that. So if you have a question, put a Q in the front and I'll be able to identify it much quicker and I can answer it much quicker. Don't forget to hit the like button for me. Really would appreciate that. Somebody said, we got to put a Q in front of that. Could you put a listing on stock you pick? So I have a whole habit. I have a whole process, and we'll talk about that a little bit in the next 2 weeks here as we talk about the common investing mistakes and how to avoid them. Part one today, part two next Saturday. Okay. So the first thing is be realistic with your expectations. Stop expecting too much, right? Getting too hyped, too fast, wanting too big of returns too soon. And it doesn't happen, and you get discouraged and you get mad, you get upset, you get worried, you get stressed. It's because you're expecting too much too soon, oftentimes. All right. Now, the second thing, the second common investing mistake, we're going to do 10 today, 10 next week. Number two is um, and this is, people always miss this. Okay. They always miss this. Okay. Let me start with an example. Listen, when you go start a business, what's the very first thing that they tell you you should have to start a business? If you want to have a successful business, they tell you to create this so that you can think about all the different scenarios and all the different possibilities and all the different problems and all the different expenses and all the different things that could go wrong, may go right. What do they tell you to create? They tell you to create a business plan so that you have something written down to work your business from. So the same concept applies when you're talking about investing your money. The problem with most people is they don't have a clear cut investment, and I'm going to say goals, right? We'll talk about a plan later, but we're talking about goals, not having clear cut goals. What do you want? When you start a business, you develop a business plan, and the very first piece of that is what? A mission, goals, etc. Those are the top of at the top of the heap of a business plan, right? So at the top of a heap, the heap of your strategy in terms of investing needs to be clear cut goals, right? If you don't know where you're going with your investments, you could end up anywhere. And this is why a lot of people end up seeing a hot stock, they go that direction. Seeing a hot stock, they go that direction. Seeing that super duper investment, they go out and get that. Listen, when you don't have a goal or goals in terms of investing, you're going to end up investing in any and everything just to chase the money, chase what's happening, chase the latest this, the latest that. You get hyped. Yeah. Oh, that's doing well. Let's go. Most people don't have goals when it comes to investing. And this is why they ask the questions sometimes, not all the time, but sometimes they just want to know what you think. But sometimes people ask questions because they're not following a plan based on their goals, right? Everything from the investment plan to the strategies, the portfolio, all that stuff. You got to keep your goals and the objectives that you have in mind when you're investing, right? Too many investors focus on the latest fad, right? What's happening right now? Right now, it's AI, it's technology. What's happening right now, right? And they try to maximize these short-term type gains and stuff, right? Instead of designing goals, investing goals that can give them long-term success, long-term guidance, long-term road to be on. Listen, nothing wrong with flexibility. I get it. Flexibility is cool, right? When you drive down any road in America, typically, most roads in America, they always have what on it? They have a shoulder, right? The shoulder of the road is there for emergencies, for some flexibility. You know, you got an exit coming up. You can flex a little bit. You don't have to stay on the same road exactly. Same concept with your money, with your investing, right? Set a goal as your guardrail to keep you focused and in center and where you're going and know where you're going and how to get there and when you want to get there, how much you want to spend to get there. What do you have all that goals, right? I'm telling you, you can also be flexible, but you got to have a direction, right? You got to have a direction. Right? If you go out in the middle of nowhere, in the middle of the woods, and you want to set up a small city of 20 acre, I mean 20 mile by 20 mile, and you're sitting in the middle of a big old gigantic forest, what's the first thing you got to set up in that forest? You got to set up directions for people to go. You got to set up roads. So the roadmap for you is starting with your goals. What do you want to achieve? When do you need this money? How do you want your money to go? What types of investments and all that's a part of your strategy, but goals head the list, and goals have to be specific. Your investment goal cannot be, I just want to put a little more money towards the stock market this year. That's not a goal, right? Has to be specific. Every time. Now, I've been talking about goals for a long time, and you hear me talk about on this channel a lot, right? I used to teach goal setting long time ago. But whenever I teach it or talk about it, I really have to say that it's not enough just to set a big old nice specific goal with dollar amounts and time amounts. That's great. It's wonderful. Looks good on paper. But you often also have to have some type of action steps to reach the goal. What are you going to do every day in terms of your investments? What are you going to do every day in terms of what you're investing your money in? What are you going to do once a week, right? So have goals, right? Long term, short term. Don't do what a lot of people do. And this is what a lot of people do. I see it all the time, and you guys can vouch for this, I'm sure. People start investing and then they come up with their goals later. People start investing and putting their money in Nvidia and Broadcom and you name it, AT&T, whatever. People start putting their money in Palantir, and then after they do that for a year or two or three or 5 or 10 years, then they say, you know what, I need to have some goals. They do it after the fact. But I'm saying you want to put your investment goals first, right? And I know, like I said, we got some intermediate people in here. We got some beginners in here, but we got all levels of people in here. We got a few super duper seasoned people in here. But if you are a beginner or intermediate, stop what you're doing and set some goals for your investments, for your investing, right? Don't make a plan after you start investing. Although for most of you that are beginners or intermediate, you'll have to do it now, right? But you really want to do it up front. Okay, if you're an intermediate investor and you've been investing for 3 or 4 or 5 years, great. Now you can make some goals, and now you have goals that are short term, long term, and action steps to go with it, and let this carry you from here on out, right? Just like you do a business plan when you want a business to be successful, you do with your investing when you want your investments to be successful. Come up with some goals. Rhonda, let's see. Precious Love is in here. Good to have you. Hey, let's see. Boom, boom, boom. Question. I'm young. Is it okay for me to park a majority of my money in risky tech and semiconductor ETFs? Semiconductor ETFs, I plan to hold a long time. Jimbo, nothing wrong with you being young. Thank you for being here. Appreciate the question. Thank you for asking. And I just highlighted it right here so we could answer it real quick. And you guys can help me answer. We got some pretty savvy and smart, intelligent, great people in this chat, and they can really help dig in here too. For me, I don't think there's anything wrong with you putting a nice chunk of your money into tech stocks. But I would say this, Jimbo, make sure you spread it around. When you say a majority, that tells me you're thinking more like 60% of your money in tech stocks. I don't necessarily think that's the greatest idea. I think you need to kind of spread it around a little bit more, have a little bit more diversity than just having most of your money, 60, 70% in tech stocks. You can do it. I'm not mad at you. Do your research. And this is your decision. It's your money. This is not financial advice. It's just my opinion. Okay. But I'm a little older too, right? I'd like to see a little bit of diversification even at your younger age instead of 70% being all go or most go in tech stocks and semiconductors. Okay. So that's my opinion. All right. And you guys can help me answer that question to Jimbo, but I appreciate you asking that question. Thank you so much. Number three, let's go to the third thing. The third common investing mistake, and here's how you can avoid it, is just what Jimbo just asked, and that's kind of was a good segue there. But he asked, okay, should I have most? I'm young, right? So I got some time. Should I have 60% of my money in tech stocks? Number three common mistake is failing to diversify enough. Great segue, Jimbo. Appreciate it. Right? You have to create a portfolio that has the potential to withstand issues, problems, and things. You have to create a portfolio, an investment portfolio. And if you're an investor, even if you're a beginner, you still have a portfolio. Don't think that it takes, 35 years of investing to have a portfolio. You have a portfolio already, right? Your portfolio is whatever you have and own, right? Your investment portfolio could be can be comprised of real estate, stocks, including ETFs and index funds and individual stocks. It could also be comprised of some silver, whatever it may be, right? But you have a portfolio. The key is making sure you diversify that portfolio, right? That way you can appropriately address risk, because this is one thing that people tend to not focus too much on, and that is risk. Right? People don't understand that every single time you're dealing with money, you're taking a risk. There's risk involved. Okay? Always risk involved, right? You own a 10-year-old car, and instead of the car needs a new engine, you decide to put a new engine in there for $4,000 as opposed to going buying you another car. That's risk. You're taking a risk, right? By putting the new engine in there. Anytime you deal with money in any capacity, it's risk. And most people do not account for risk when they make financial decisions. Well, listen, one of the ways that you can mitigate some risk is by diversifying enough, right? Having all your money in Nvidia, Broadcom, and AMD is not diversified enough, right? You have all of your investments, no 401k, no 403b, but you've got $60,000, 20,000 in Nvidia, 20,000 in Broadcom, and 20,000 in AMD. You're not you are not diverse enough, right? Because you can't stand your risk tolerance level has to be super duper high, right? If you risk having all your $60,000, all the money to your name invested in three stocks, right? So you have to diversify. Now, here's the kicker, though. Always understand this, guys. The more you the more you diversify and lower your risk, the less potential reward you can get. And I say that to say that you have to understand both sides of that coin. When you diversify, you actually lower your risk, but you also lower your potential reward and your potential downturns, right? You lower the risk for both. So all of this has to be taken in consideration when you're investing, okay? So, just be sure you understand the important. I cannot stress diversification enough, because I get comment after comment after comment after email at telling me, "Hey, I've got all my money in boom, boom, and boom." And I'm saying, you don't want to have all your money in just boom, boom, and boom. Now, listen, if you say, I want to have all my money in VOO, all my money in VOO, or all my money in VTI, right? VTI is the total stock market. VOO is the S&P 500. If you say that, you've already spread your risk, because all your money in VOO is investing in 500 plus companies in a bucket of stocks called an ETF, called VOO, right? So that's diversification right there. That's cool. It's one ETF, but it's 500 plus companies, right? So I just cannot stress again enough how important diversification is. But remember, diversification can affect performance. Too much diversification can affect performance. The best course of action for investors is to seek the balance that you are most comfortable with. Seek the balance that you are most comfortable with. If the balance requires you to have, if your personal risk tolerance says, I have 3 ETFs and 10 individual stocks. Cool. If that's comfortable for you and you've got some balance, right? That's very, very important. So you can do that, right? So the deal is that you've got to figure out what's best for you, right? You've got to figure out what's best for you. Precious Love said VOO for retirement. I have some S&P 500, but I like tech. What can I say? Nothing wrong with that, right? Don't forget to hit the like button. Thanks, Sunset on the Ocean. Please, appreciate you hitting the like button. Thank you so much for mentioning that. Stock market like Bitcoin. Oh, James Lee. All right. Let's see here. I put all my money in NVIDIA, then listening. Uh, Not sure what you're saying. Kidra, right? So let's go to number 4. We got 10 of these. Excuse me. Number 4, the fourth common investing mistake and how to avoid it is focusing too heavy on short-term performance, right? Let me pull up something real quick. Let me share my screen real quick. Let me see if I can find a good chart real quick here. Um, let's see if I can find one. Help me out here. Got the S&P 500. All right, so I want to share my screen with you guys real quick if you're okay with that. I just want to show you something regarding this one that says, okay, focusing too heavy on short-term performance of the S&P 500, right? Let's see here. Give me a quick, let's see. And I'll share my screen with you guys. Here it is right here. 90 years of the S&P 500. Let me see if we can pull this up. And this is kind of in line with just being careful not to focus solely on short-term performance of a stock or of an index, right? So let's open up the screen where we are. Boom, boom, bada bing, bada bang. Okay, this one, we're taking this one off the Motley Fool. Let me share it here. All right. So the reason I don't want you guys to focus on um, short-term performance of stocks or indexes is because in the short term, we get a lot of chinks. And when I say, I mean, the stock market kind of chinking down, chinking back up, right? Boom, boom. Let's see here. Let me go and hide myself a little bit, right? So if you take a look at this chart here, guys, this chart is the only stock market chart that matters. All right. So 1970 up until maybe about 2020 or so. It doesn't have to be you know, a modern chart. I want to look at the whole big picture of the stock market. So if you look at the stock market, you see it going up, coming down. This is 1960. Let's see here. Yeah, this is an old chart, but it's okay. It still illustrates the point. So you see all these little small chinks in the market. Boom, goes up, comes down, goes up, comes down, goes up, comes down, goes back up, comes down, goes down, goes up, comes down, goes up, comes down, goes up, 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 up. Boom, big time went down around 2008 or so, right? And back up. Here's the point of this chart. Okay, the point of this chart is just to say, if you're focusing on the short term, and the short term could be within just a couple of years or so, 1 or 2 years, you're seeing you might get hit with some of these chinks where it goes down, right? But if you focus on the longer term, you get typically the stock market goes up over the course of a long term of a long period of time. The stock market has never lost money in any 20-year time span, right? So if you're not focused on the long term in terms of investing, you're going to be really, really affected tremendously and really emotionally tied to all of these small little chinks that you see in front of you, right? Every time the market chinks down a little bit, you're going to get nervous, you're going to get upset, you're going to get emotional. This is why you don't want to focus so heavily on short-term performance of the stock market. Okay? There's two time frames that are really the most important to keep in mind, right? Short term and long term, or short term and everything else, really. That's why it's important to consider when you're out here investing, being a new investor, a long term seasoned investor, intermediate. You want to be focused on that long term, right? As opposed to speculating on the short term performance. Hey, I'll mention it several times, but I'll mention it here first. I'm not into day trading, right? I know some people that have really lost a lot of money in this day trading thing. That's more speculative and that's more, gambling on the short-term performance of a stock, right? So you have to be careful with looking at things in the short term and focus more on the long term so you don't have a fit every 2 days or every 2 weeks, right? And that's the same thing with Nvidia. We've been talking about Nvidia, but some people are like, Nvidia is not doing very well. I just went out and bought 10 shares or 30 shares. Listen, it takes time over the course of 5, 3, 4, 5, 10, 15 years, you're going to see the gains that you want. But sometimes you don't see it in the short term, and you feel like it's a disaster because you can't make that, you didn't make the guess right, right? But you got to be careful. Looking past the short term chatter and hype and all that stuff is going to be helpful to you as an investor in the long run, right? If you find yourself always looking at the short term and checking it and rechecking it and going back to checking it and watching the charts carefully to see what happened on a daily basis, if you do that on a regular basis, you're going to find yourself way more stressed out than you should be, way more stressed out than you need to be, right? So think about investing as a long-term endeavor, not a short-term endeavor, right? Very important, guys. Okay, so let's see. I'm gonna run back to the chat here. Uh, let's see. Listen to you. Boom, boom, boom. I'm good. How are you today? Okay, good. Rhonda, speaking to each other. Good. Let's see. VOO is green. Great. Yes, excellent. Long term, all the way. Ride the waves. Just chill out, relax, calm down. No, I don't do options, Walla Mala. I don't really mess with options, calls, and puts and all that good stuff. The day traders make more money selling their courses. Yeah, precious love. They do make good money selling those courses for sure, right? Teaching you how to day trade. The reason day trading is so attractive is because day trading is sort of quick money. It's sort of like, day trading is sort of like in the stock market world, sort of like wholesaling property, right? You make your quick 10, 5, your 3, 4, 5, $10,000 in a matter of 30 days, and you're in a deal and you're out of a deal. You don't have to put up any of your money. You just jump in, get a little proportion of it, and you act as a middleman sort of, and when you're wholesaling, and you jump right out, right? So day trading kind of reminds me of that. I'm not a day trader, right? But I know some people that have lost a lot of money. I know some people that have made a lot of money in day trading also. But the kicker with day trading is it's kind of like gambling, right? You make a lot of money, you spend a lot of money to make a lot of money. So it sometimes becomes a wash or a big loss for a lot of people. So be careful with day trading, meaning you buy a stock at 10 a.m., you turn around, trade that at a certain price, you turn around, trade that stock later in the day, and you make the profit. Yeah, all right. You buy 100 shares of XYZ at $100. It goes to 102. You turn around, sell though, right? Nothing wrong with it if that's what you do. But I'm saying for newer people, newer beginners, that's a lot of speculating and a lot of risk, right? So be careful about looking at short term, refocus and look at long term, right? All right. Think very carefully about that. Hey, Alvira's in the house. Good to have you. Alvira's checking in as always from Queens, New York. I got a horrible New York accent. Sorry. Somebody said, what do I think of Bitcoin investing? I don't invest in Bitcoin. I do own a little bit of Ethereum, though, but a very little bit. Cryptocurrency may be 0.00001% of my total portfolio. just not sold on it at this point, right? So if you invest in Bitcoin, I'm not mad at you. I'm not one of these people that are going to say you're an idiot for investing in Bitcoin. No, you're not an idiot, but just be very careful, spread your money around, and don't get caught up putting all your money in Bitcoin because or read about or saw a YouTube video about 10 investors in Bitcoin that put in 40 bucks back in, 2012, and now they're all multimillionaires, and it gets you hyped up. All it does is it's playing on your emotions, right? So let's jump to number 5. Number 5 is similar, since a good segue again, buying high and selling low. Buying high amongst everybody hyped up. Yeah, let's get hyped up, and then selling low, which is the absolute opposite of what you should do with investing, right? The absolute opposite is investing or buying high and selling low. But here's what happens. People get into their emotions and their feelings, and they make the cardinal errors of buying high and selling when that thing starts to drop and you don't know when to get out. You bought Tesla at its peak a year ago or a year and a half ago, and then Tesla did the big nosedive, and you said, "Oh my gosh, I got to sell it before it goes to nothing," and you sell it low, right? The fundamental principle of investing is to buy low and hold, or buy low and sell high, right? Right? When I was selling eBay, right? I had to make sure I had a margin, right? And to make sure I had a margin, I couldn't buy a pair of shoes for 50 bucks that I could only sell for 50 bucks, right? Or buy a shoe for $50 that I had to sell for $35. I had to make that decision immediately before I bought the shoe. And after a while, I could see a shoe point blank, pick it up. Oh, boom, 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 turn it around. I can't sell this shoe for more than 10 bucks on eBay. I'm not going to spend more than 10 bucks, right? The whole purpose of eBay was to buy low and sell high. The whole purpose of stocks is to buy low and sell high, or hold until you know it may go up, or you perceive that it will go up, right? Instead of being rational with the stock market purchases that we make into stocks, for a lot of people, a lot of our investment decisions are motivated really by two big emotions. Two ginormous emotions really run the stock market for average retail investors like me and you. There's two ginormous emotions that destroy a lot of our ability to actually win in the stock market. Two ginormous emotions, right? Two, two, two ginormous emotions. The first emotion that always gets us and leaves us thinking irrational when it comes to the stock market is fear. Fear of missing out, fear of losing money, right? Fear of getting on board on something too late, right? That emotion drives a lot of our decisions when it comes to investing. And it's the wrong emotion to be investing with. It's a big mistake. The other emotion that gets us and forces us oftentimes to end up selling low is because of greed. Greed, right? We want more. We want more. We can't get enough. We want more. Grow, 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 grow. And we do what it takes to grow. And next thing you know, we end up selling low, right? Right. In a lot of cases, you have investors who, they buy high trying to maximize some type of short-term return, right? That happens quite a bit, instead of just holding it for the long haul, right? Or to help them achieve their long-term goals. So you got to be very careful, right? Once an investment has become popular, once it's become incredibly popular, most times it becomes more difficult to have an edge once it becomes incredibly popular. it becomes a little rougher or harder to you to now have an edge, right? The people that first bought Nvidia back in 2010 when it was $12 a share, they got in early. But it's but in the last year, 2, 3 year, 4 years, as Nvidia's momentum has gained the public's attention, it's become a little more difficult to have an edge, right? Sure, you're going to get your returns because it's in a market called AI that's emerging, right? It's emerging technology at the forefront of all of the emerging technology around the AI space, right? From semiconductors to data centers to GPUs, you name it, right? But the best edge was prior to this type of hoopla and hype around NVIDIA. The best edge to have gotten into Broadcom was before this hoopla and hype about the AI stocks. And right, that was the best time. So, what happens to a lot of us, again, it's fear and it's greed. Those are huge. And so we end up oftentimes buying high, messing up the cardinal rule of investing of buying high and selling low. Big, huge mistake, right? Let's see here. Go back to the chat just for a second here. Let's see. Now, how much did I miss? Late for my lecture. Alvira, you're not late. We're just getting started, Alvira. We've been through 5 of the top 20 common investing mistakes and how to avoid them. This week, we're doing the first 10. Next week, we're doing the second 10. So if you just got here, feel free to rewind this thing back to the beginning so you get to the first 5. I might do a little summary a little later, but I'm just trying to make sure we help these new investors, right? We have a lot of beginning investors on this channel and in this chat. And we have a lot of intermediate investors, right? So we don't have a lot of super duper seasoned people in the chat, right? But that's okay. That's not a big deal, right? We're here to sort of help each other learn, teach, learn, teach, learn, teach, etc. So we're all good. We're all trying to learn. We're all trying to get better. All right. Let's see here. Somebody said scared money. Let's see. You can't tell us have a bad New York accent without giving us an example. I don't have an example. Let me see. Give me something to say in New York accent. What up, son? No, I don't know what to say. I have a horrible New York accent. Okay, let's see. Somebody said the emotions are greed and panic. Yeah, greed, panic, fear, all kind of fall into the same realm, right? So let's go to number 6. Number 6 is, and it goes back to what we said before, getting rid of stocks too often, getting rid of stocks too much, getting rid of stocks too fast, getting rid of stocks too quick, not being patient enough, trading too much and trading too often, right? When you're investing, guys, when you're investing, hear me out. Patience is a virtue. Patience, 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 right? It takes time to reap the benefits of investments, right? It takes time to reap the investments or the benefits of how you have your stuff allocated, how you have your stuff diversified, right? Right? It takes time, right? It just takes time. Relax, be patient, chill, turn off Bloomberg TV for a while, right? Turn off Kramer for a while. Kramer's the guy that screams at everybody, right? He's screaming and throwing stuff or something like that. He's been around for a long time. Listen, turn off some of the noise that you hear and see and listen to on social media, right? You have to be patient, be patient, be patient, right? Don't be careful about your impulses, right? I just me personally, I don't suggest too much actively trading and getting. I like to buy stocks for the long haul. Now that makes me a little different than some people because some people are chasing the quick money. Some people are chasing the fast results. Me, not necessarily, right? I'm investing for my grandchildren. This is how I look at investing. So I personally, because of my risk tolerance, I take a little more risk in terms of my investment style, but I'm also at the same time pretty conservative too. But I understand that the fruition of the money that I'm making in the markets today, I may never use that money. But 30, 40, 50 years from now, somebody may use the money if money is still usable, right? So in it for the long haul. Patience, patience, patience. Listen, if you want to lose money consistently in the stock market, be impatient, right? Be impatient. You'll consistently lose money over the long stretch of time. There are seasoned investors who do this for a living for the last 30 or 40 years who make mistakes all the time, pick losers all the time. So don't be hard on yourself if you make a mistake. Oh, you pick these 15 stocks and some of them are not doing as well as you thought. Patience, relax. Don't beat yourself up. It happens, right? Pivot, make some changes, go a slightly different direction, but understand the value of patience when you're investing. Okay. Number 7, paying too much in fees, paying too much in commissions. One of the reasons that I really, really, really like ETFs is because of their low fees, passively managed, right? But when you invest in a really expensive fund or you pay too much in advisory fees or you name it, right? A small increase in fees can have a big effect on your money for a long down the road over the course of 5, 10, 15, 20 years. People don't see it, but you get some high fees snuck into an investment or snuck into an advisor's fees. That's okay, let me put it like this. I always say this, guys, and people kind of beat me up for this, but that's okay. You can beat me up. Boom, 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 boom. I don't think most people, until you get to more than 700, 8,000, over a million, 2 million, I don't think most people need an advisor, right? I don't think most people need an advisor. Is learning about money difficult? It can be for some people, and that's okay. It's not a big deal, right? Some people have an issue with math and the multiplication, division, subtraction, addition, all those types. That's okay if that's you. That's not a bad thing, right? It happens. But I think with enough studying and research, most individuals that earn money can actually invest money pretty much on their own up until you get to a certain level when you may want to get some help and some answers to some questions. But a problem that a lot of people do is they go out and get an advisor immediately, and that advisor is on a commission basis, and every time you make money in your investment, the advisor makes money, and over the course of 20 years of having that advisor, you paid that advisor. Yeah, your money grew to $900,000, right? But in the meantime, you paid that advisor 200,000, and all they did was just pick the same things that you picked, right? I'm not saying having an advisor is bad or horrible, but I think most of what you can do and grow can be done with the right self-study at this point, right? Before when you're opening your account and you're looking, you need to understand the cost of every investment decision you make. Look for funds, index, ETF, whatever it could be, mutual funds that have fees that make sense to you. And if you are having an advisor, make sure that you are receiving tremendous amounts of value for what they're giving you. And if they just have your money invested in super duper simple basic things that you can invest in, you may not need that advisor. You can beat me up about that advice if you want to. That's okay. Most people, in my opinion, they need a mentor or somebody to ask a few questions to. That's what most people need. And then they need to take the time and the effort to self-study, right? Take the time and the effort to self-study. Don't just think that you can ask a YouTuber what a YouTuber thinks. Could be a YouTuber, could be an uncle or somebody on the street. You still have to go back and do your own research. Look, when you have an advisor and that advisor is directing your money in a certain direction, you need to know where your money is going. And then watch this. You need to make sure you're getting value from that advisor. Because if that advisor is just putting your money in the same place you probably would have put your money and you've done the research, why do you need the advisor? Right? If the advisor has 50% of your portfolio going into VOO and 25% going in, the other 50% going across 10 stocks, why do you need the advisor? You're going to do you should be doing your research anyway. So if you're doing your research anyway, cut out the middleman. The whole industry of advising on stocks, bonds, whatever you name it, is based on because we don't want to read and do the research and learn on our own. Don't get me wrong. When you become worth 800, a million, 5 million, 10 million, okay, I get it. You need somebody to help you coordinate that, right? But for the average retail investor like me and you, who are, well, not necessarily me and you, but there's some people that are advanced in here. But like us, most of us retail investors, you don't really need an advisor, right? It's like, I don't want to pick on professions. Let me not pick on professions, right? Because I could look at several professions that are out there and you say, well, okay, what do they do for me? Okay, well, I can kind of do that on my own, right? Not a big deal. Let me go to the internet. Let me do a little research and boom, 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 boom. I don't have to pay you all this money to do something I can do. Same holds true for your 401k, 403b. Let me stress this. Let me stress this because a lot of people I talk to don't do this. When you are putting money towards your 401k or your 403b or your retirement plan at your job, whatever it could be, right? When you put your money towards that, you must. I'm overly stressing the word must. You have to know where they're putting your money when they invest the money for you. Okay? In other words, if you have a 401k, you should know exactly what funds your money is going into in that 401k. How are they? I've talked to so many people, you would not believe it, that when I ask them, what is your 401k invested in? I would say that 90% of the people don't know. They have no clue where their money is going. Yeah, they give me a 4% match, but guess what? They're investing your money in the bond fund that is a 1% return. But you have a choice in being in the S&P 500. But they got you sitting over there in a fund and they have you in a life cycle fund like you're going to retire in the year 2030. And so 80% of it is going in this low risk money market fund that's getting you 0.5% on an annual basis. Well, that's not where you want your money to be. You might want your money to be growing, but because you haven't taken the time to check where they're investing your 401k money, you're losing money, right? You've been at the job 15 years and you ought to have 100,000. But guess what? You only have 40,000 because you never stopped to check where they're putting your 401k money. This is a cardinal mistake that a lot of people make, right? So I kind of veered off course, but we're talking about paying too much in fees and paying too much in commissions. And how about just paying too big of a price for not knowing exactly where your money is being invested? Very, very important, guys. So this is the weekend, but tonight, pull up your account on your human resources website and see where your money is going. What is the name of this fund that they're putting your money into? Do you have choices? Right? What are those choices? What is the past performance of the funds that they have you automatically enrolled in at your job under your 401k that you're dropping 5% to get the match or 10 or 20%? What funds do they have you invested in? You got to know. That's kind of a bonus common investing mistake, but that's a real investing mistake that a lot of us can actually relate to, right? So, paying too much in fees, paying too much in commissions, slash not knowing where your money is going in your 401k or your 403b. You got to know it. I don't care if you have a 403b, which is the same as a 401k, except for a nonprofit organization here in America, right? So a 403b, Yeah, you've been there for 20 years at the nonprofit organization, right? And they've been matching 5 or 6% of your money, and you've been putting this money in. But where are they putting it? What are they investing in? You got to know that, right? Let's go to number 8. Number 8, common investing mistake and how to avoid it. Not reviewing all of your investments regularly. Now, I'm not telling you that you have to or should check your investments every day. But I'm saying maybe once every couple of months, you need to at least take a look. Maybe at least once a month, every 3 months, you need to take a look, right? If you're invested in a diversified portfolio, like we mentioned before, the chances are there'll be some things that go up and go down. You're not going to get those big swings necessarily because you're spread across, but you still want to keep an eye on what you're doing at the end of a quarter, right? Or at the end of at least 6 months, right? You want to take a look at the portfolio that you've built, right? So you don't get too far off the track and you still are within the parameters of your goals that we talked about, right? And also so you can still make sure that what you're investing in makes sense to you, right? Makes sense to your goals and your situation, right? Think about that as well. Let's go to number 9. And guys, don't forget, hey, I just get going, I get talking, but listen, somebody said I check every day, Clint Perry. Yeah, I don't check every day, honestly. Now that I'm going to be doing some single stocks and I'm doing more of that and more investigating that, I check more often, obviously, right? Because I want to look and see what to buy, what to put on my watch list. Over on our other membership site, guys, that link is in the description box below. You can go over there and join us at that link. That's where we're going to be really digging further into investing into single stocks. And I want you guys to come along with me over there. So the first link in the description box, depending on where you're watching, here on YouTube at least, I know for sure, is a link to that other site where we're going to be actually doing more individual stock investing. And if you're on Facebook, you got to come over to YouTube and take a look at it. If you're on LinkedIn, you got to come over to YouTube to take a look at it, probably in the description box. So number 9 is this: the assessment of risk. A common investment mistake is the assessment of risk. Taking too much risk, taking too little risk, taking the wrong types of risk, right? Investing involves some level of risk. I don't care again I don't care what you're investing in. You could be investing in corn, right? There's still risk. You could be investing in multifamily properties, real estate. There's still some risk, right? And obviously in the stock market, there's risk. Taking too much risk is a problem for some people. Be careful with your risk. Now, I've mentioned risk several times on this video, and I mentioned it for a reason several times, purposely, because I want you guys to get better at understanding the value of properly assessing risk and the value of properly mitigating risk, right? Taking too much risk is a problem. Taking too little risk is a problem, right? Taking all your money and putting it under your mattress because you're scared and fearful to take a risk, that's a risk too, right? So the other thing is you got to kind of know yourself too when it comes to risk, all right? Know yourself. What's your risk tolerance? What can you take? Are you 60 years old and you want to make sure this money is available to you in the short term because you're going to start using it when you turn 63, 62? Right? What's your risk? Are you 30 years old and you're thinking about, I don't need this money for at least 50, 20 or 30 years so I can be a little more risky, like the question was asked earlier? Absolutely. Right? But make sure you know your emotional and financial abilities to take risk, right? And then recognize risk when you see it. When you're evaluating a stock like Nvidia, you have to think, okay, Nvidia is an AI stock. Yay, upside. Nvidia is a player in a lot of places around the AI arena, right? Yay, upside. But Nvidia also is exposed to litigation. Ooh, that could be a risk, right? Downside. Nvidia is also exposed to other competitors, right? Boom, another downfall, right? Possible competitors, Apple, Amazon, whatever, AMDs, you name it, right? TMSI or TMCI, whatever it is, Taiwan Semiconductors. Listen, so there's upsides and there's downsides. You need to In your plan, your investment strategy plan, whatever it could be, you need to be coming up with what could be um, potential risk, right? Potential risk, right? Be thinking about it. Understand the risk. Think about the pros and the cons, right? Think about the industry. Think about the market. Think about spending. Think about consumption. Think about consumers and how we spend and what is the consumer sentiment, right? Think about the fact that in 3 or 4 months we have a presidential election and things could look a little shaky. People could be buckling down, right? You got to think about what's happening in the larger world around your particular stock that you want to buy or purchase. You got to be thinking about the whole gamut of stuff that could go right and stuff that could go wrong when you're making a decision to invest in a stock, right? I always say right, but you get what I mean, right? I said it again. Number 10, let's go to number 10. Again, 20 common investing mistakes and how to avoid them. This week is the first 10. Next week is the next 10. And don't worry, next week I might do a little recap, 3-minute recap of the first 10. But if you're getting here late, rewind this thing back to the beginning so you can see the whole kit and caboodle, right? Number 10 is simply this. And a lot of people fall victim to this one, right? This is a big, big, big common investing mistake that is just too common and it's unfortunate. And I fell victim to it. Matter of fact, Matter of fact, I think tomorrow I'm going to do a live about my problem with this one. I'm going to do a live on this channel at 1 p.m. Central Standard Time tomorrow, and I'm going to talk about my mistake, right? Number 10 is this: investing too little, not investing enough money, right? Not investing enough money. Big common mistake, right? You say, I'm going to get the match at my job. Yay, I'm going to get the match. They match 2%. Yay, I'm going to get the match. Woo, I'm really doing some stuff. I got 2% plus the match. Woo, big baller shot caller. Yay, hyped up. Woo, 2%. Okay, relax. It's 2%. Okay, right? You make $35,000 a year and you're dropping 2% into the market. I'm not mad at you because anything is better than nothing. That's for sure. That's a no-brainer. Anything is better than nothing, no doubt. But it's 2%, right? It's 2%. I want you to stretch yourself. I want you to stretch yourself um, more than just getting the match at the job. You can do more. You can go above and beyond. You can go to 5%. You can probably go to 10% if you cut out a couple extra things that you do here and there. Try to live a little more frugal. Now, I'm not telling you to live like a pauper in the street, right? Not telling you that. No, I'm not saying that at all. I'm just saying you could probably do a little more. Let's stretch you out just a little bit. Let's take that 2%. Let's stretch it out every single year. Let's up that 2% by 2% a year. All right. So in 5 years, you're at 12%. Because every single year when you got that raise, you just went ahead and spent that raise on adding to the amount you were putting towards your 401k or your Roth IRA or your individual retirement account at Vanguard or Fidelity or Charles Schwab or Robinhood. You just stretch that thing out. I'm telling you to stretch. I'm telling you, you got to stretch that thing out. 2% is good. It's dandy. It's better than nothing. But you got to get off that 2%. You got to get off that 2%. Do you want to have $20,000 in 20 years or do you want to have $400,000 in 20 years? Right? So, what do you want? Let's go back to those goals. The very first thing I mentioned, those goals. What is your goals looking like? Oh, I want to retire as a millionaire at the age of 58. Okay, if you're 30 years old and you're going to retire as a millionaire at the age of 58, you got to do more than 2%. You just can't do 2%. It's too little. And you know what happens is people get so hyped and so happy and so proud and yes, I'm doing a good job. I'm hyped and I'm happy and I'm proud for you, right? You're doing a great job. But I want you to do more. I want you to stretch, right? Stop getting this temporary pleasure at the expense of your future wealth. Stop taking this temporary feel good moment at the expense of being able to do what you want to do in 15 years. Travel where you want to travel in 15 years. Buy what you want to buy in 15 years, right? We got to stop looking at fear to invest more because I know there's a lot of people that have that fear, right? They say, I want to invest more, but I'm a little nervous about the stock market. I'm a little nervous about this investing. You got to get over that fear. That fear can keep you poor. Fear can keep you struggling. Fear can keep you right up on the struggle bus. You got to break free of that. And you have to stretch yourself, meaning you might have to be a little more frugal in another area of your life to invest a little more for your future life. At the end of every broadcast, you hear me say the best person to take care of the young you is the old you is the young you. That means the young you cannot be stuck on 2%, investing only 2% of your money. The young you has to make some sacrifices to get to where you want to go down the road. That's huge. And a lot of people miss this point. They invest, but they just don't invest enough, right? And then by not investing enough, they have these unrealistic expectations that I talked about earlier. They expect too much from too little. You put in 2% a month, 2% a paycheck, and you think that you're supposed to have $1 million in 20 years. Compound interest works, but it don't work like that, right? But you don't invest enough because your goals are not clear. You don't invest enough because you fail to diversify. You don't invest enough because you're focusing on short term as opposed to long term. Right? When you invest, you got to be able to have a vision. You have If you want to be a good investor, I don't care if it's real estate, stock market. Let's talk about those two investments. You got to be able to be a person that is able to see without your eyes, to see what could be down the road. When I go evaluate a piece of property, I look at a piece of property and say, okay, if I just do this and I do that, and I have to have an imagination walking into a piece of property to actually see the investment for what it could be. So I have to, in my head, say, okay, put a new door there. Okay, if we add some windows here, we throw some carpet over here. Okay, fix that crack in the drywall over there. We add, okay, we put down that flooring over here. Then on the outside, we put a couple of nice little bushes right here, maybe a rose bush here, maybe some flowers over here. We regrade what's going right into. We put the new gutters. We throw a new roof on there. We have some new soffits, new fascia. We rolling, right? I have to see that. The same thing applies with your personal finances and your investments. You got to see more than just the weekend or more than just 6 months. You have to be patient enough to see that if I increase my investments today, I'm going to have more money down the road. Let me go over here and play with this compound calculator to see if I go ahead and up my 2% to 7%. Oh my goodness, my money goes crazy. Now, if I get crazy and go up to 12 and 15%, I'm balling in 15 years, right? But you got to be able to see what you cannot see with your eyes when you invest. Therefore, if you do that, you're going to be more apt and more willing to put in more than 2% and invest more as opposed to investing too little. Cardinal common investing mistake, right? Right? Couple things to think about and let's talk about how to avoid investing too little. Automatic investments. Try it. 100 bucks comes out of your bank account every single month. 300 comes out of your bank account every single month. The other thing, increase your contributions to whatever you're investing in gradually over time. Start with a small amount you think you can afford and increase it gradually. as your income grows, as your debts fall off, all that good stuff, right? And then, you want to be informed too, right? It's one thing to put 2% towards your 401k when you don't know where the money is going. You haven't taken that time to inquire about it, right? But how about putting 5% in there and then go into your 401k and tell them where to put your money based on the choices they give you? Be informed, right? Let me run through the chat. Haven't been in the chat in a while. Apologize, guys. Let's see here. ETF dollars. Let's see. Life is risk every day, no doubt. Let's see here. Got any questions? Put a Q up there for me. NVIDIA is also close to the top. Let's see. I use some profits to purchase physical assets. Nothing wrong with physical assets. Let's see. Do I do a live every Sunday? Most Sundays I do, and I go at 1 p.m. Central Standard Time. John, 1 p.m. Central Standard Time is when I go. My job matches 6%. Willie Wilo, that's big. That's huge. That's quite a bit, right? Yeah, some people get real hyped on 2%, and I'm saying, man, you got to up that thing, right? You got to up that thing. 401k folks should open a separate cash brokerage account to learn more and call all the shots. Yeah, in your 401k, you're sort of limited in a certain way. That's why some people like the strategy of getting the match at the job and then going out and getting their own Roth IRA at Vanguard. And then in that Roth IRA, you can direct the money where you want it to go, and you can pick and choose your own funds, right? Good point, Pistol Pete. Thanks for bringing that out. Let's see. My job matches 3%. I realized I was paying 5%, so I upped my contributions. Brad, congratulations. 20%. I like it. I like it. Let's see. How do you suggest balancing paying off a 5.34% student loan? Let me answer this question. Let me highlight it. A 5.3% student loan, 5.34% student loan of $6,900 versus investing more. Currently 4% in 401k, but want to increase. Here's how I balance that, John. Good question, too. John, pay off the debt. Keep this is how I balance it. I always want you to get the match at your job. Always. Do not stop getting the match no matter what. Always get the match. Some people say, no, you stop everything until you actually get out of debt. Don't do that. Don't do that. Get the match at your job. But don't be putting 10 and 20% of your paychecks every 2 weeks into the job's 401k when you still got $7,000 debt laying over there. Get the match at the job, but then go ahead and pay off the debt as soon as possible. Get the debt out of your way. I'm not a big fan of debt unless the debt is going up in value. I don't like debt, right? The only debt I currently have is on 3 pieces of real estate, small amounts of debt on all 3. But the real estate is increasing in value. And 2 of them, at least, I'm getting rents from, right? But get rid of the debt. That's what I would do, John. Keep investing the 4% and 86 that debt. You guys know what 86 means? I used to be a waiter for a long time, and if we were out of baked potatoes, 86 baked potatoes, that means we're out of it, right? 86 meatloaf, 86 mashed potatoes, right? You yell that back, 86, or you write it on the board, right? Yeah, 86. So yeah, 86 them loans as soon as possible, right? Good question. I appreciate it, John. Let's see here. Stock market crash. Boom, 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 boom. I'm just reading through chats here. Guys, don't forget to hit the like button. Hit the thumbs up button for me. I really would appreciate it. Was there a question I missed? Let's see here. How long did it take you to hit your first 100,000? Good question, Miss Reynolds. How long did it take me to hit my first 100,000? I think at my jobs, I work for the federal government for many, many years, right? So I think at my job's 401k, it's not a 401k, it's called a TSP, thrift savings plan. I think I hit that after about the first, I think maybe I'm kind of stabbing at this, but I think 9 or 10 years or so, maybe 11 years or so. Maybe 2013 or something. I had 100,000 in there. No. It was probably after that. It's probably 2012, 13, 14. But the kicker with that is I didn't have a net worth of $100,000 probably until 2000. Probably 2013, 14 or so. 12, 13 years ago or so. And did I do it on my own? When you say on your own, yes, I've never had an advisor. I've never used an advisor. Yeah, he's right. Charlie Munger, RIP to Charlie Munger. He's right. It takes your first 100K is difficult. When you get more than $100,000 invested in your 401K, 403B into your brokerage account, you see large swings in your money. Especially when you get to like $500,000 invested in your 401K or your investment accounts, you can see literally a swing. You can lose $100,000 in a year easily. 2022, I think my accounts went down by almost $100,000 in 2022. Right? S&P was down negative 18% in 2022 for the year, average annual return. And so you get these large swings. But on the flip side, when you see a good year, you can see your money go up $100,000 in 1 year, right? Or less. Very easy to do that. So yeah, it took a while to get there, but once you get there, the amazing effects of compound interesting are ridiculous. So Charlie Munger was right about that. Good question, Ms. Reynolds. I appreciate that. Let's see here. Credit card debt is very high, said Precious. Let's see. I'm trying to catch up. 86 means someone is getting bounced from the bar. Oh, I didn't know they use that in the bar. Never worked in a bar, Pete, Pistol Pete. But yeah, 86 means someone's getting bounced from the bar. Yeah, getting rid of them. Have no more of them. Get them out of here. I like that. Let's see. I did $500 deposit to my HYSA right away with the 5% interest, never touching the fund for one account. It took much less time than I expected to get $100,000 in savings. Yeah, it'll get there. I hope you don't have 100,000 in cash though, Ruby Ray. Here's my suggestion, Ruby Ray. Get your emergency fund in cash. And if you're trying to save for something big, maybe you're waiting on a stock market crash or you're waiting on a real estate crash, okay, keep that money available right there for you. But typically, anything above your emergency fund for most people, go ahead and put it in an investment, right? So it's not just sitting there in your savings account getting 1%, 2%, maybe 3% if you're lucky in some type of HYSA. Let's see. When I reach about 120,000 pounds in my S&P 500, I'm only at the beginning of investing. So this will be about 15 years time plan to take it out and buy a house. But boom, nothing wrong with that. I like the plan, Brad. Go for it. Brad must be in the UK. Talking about pounds. Let's see here. 86 is the year I graduated high school. Rhonda, old school. I'm 88, Rhonda. 88 was great, right? But the kicker is this, guys. Mistakes happen. Don't beat yourself up because you've made some of the mistakes that I talked about here. Don't beat yourself up, whatever you do. We all make mistakes, but thankfully we have another, we wake up another day and can do things a little bit different. Okay. I like to make sure I point this out when we're talking about mistakes in investing. Always have a plan of action. Always commit to consistency over a long stretch. Always invest in what you understand. Always understand and risk what you can afford to lose. Always diversify your investment choices. In my opinion, always consider strongly reinvesting dividends and don't panic. Don't fear. Don't let your emotions get the best of you. These were the top 10 common mistakes. Now those weren't the mistakes, right? Those were just sort of reminders. Just to recap the mistakes, guys. No, I'm not going to recap them. You go back and rewind this video and watch the video, right? I'm going to recap them next week, right? We're going to get together next week at 11 a.m. on Saturday, and we're going to talk about the other 10 common investing mistakes and how to avoid them. My goal on the channel is to make you guys, make more money, earn more money, keep more money, invest more money, grow more money, pass along to generational wealth, more money. And in the meanwhile, all the time, be comfortable with it, right? Not fearing anything, not being scared, not being afraid, but taking control over the controllables, taking control over the things that you can control, right? And all of these investment mistakes that we're talking about are things that you 100% have control over, right? I am not going to talk to you about avoiding inflation because you can't avoid. You have nothing that you can do to avoid inflation. That would be like me trying to tell you avoid. Stock market goes down, stock market goes up. I'm not going to tell you any of that because that happens, right? But I am just going to tell you about the things that you can absolutely 100% control. Give me 1 second here, guys. You guys wouldn't believe that when I'm sitting up here doing this, I actually take a few notes to myself, right? I know I'm weird, but I like to make sure I talk and mention things that are important. So I take a few notes to myself. Call me strange. All right, let's see. Are annuities a good investment? Annuities are probably some of the most complicated things in the world, right? An annuity is a product that's typically sold by an insurance company. I'm not a big fan of annuities unless you are 70 years old and you want to make sure that in the next 5 or 10 years, you got a certain amount of money coming every single month. But no, be careful about annuities. I'm not going to beat them up because they are a product and there's a place for them. But for annuities, read the fine print and understand every single piece of it, including the surrender amounts if you decide to stop it, right? So be careful with annuities, right? They're very, very complicated products. Okay. Somebody said, can you do a video on purchasing land? Sunset on the ocean. I only own, I do still own a piece of land. Matter of fact, I got to give a guy a call because he's supposed to be cutting my grass on my land. It's a very small piece of land, right? Where a house used to be. But yeah, I own a piece of land, but I don't buy a lot of land sunset on the ocean. And so unfortunately, since I don't buy a lot of land, I really would probably not feel super comfortable doing a video about purchasing land. Great question, though. Appreciate it. Financial wealth advisors help out when retirement is doing taxes. Yeah, I got a good CPA. Yeah, I believe in a good CPA. Let's see, generational wealth doesn't always work out. You're right about that, the Wallamala. One way you can mitigate generational wealth is by having you a good solid estate plan with some really important instructions in the estate plan. Let's see here. Hey, Pam Lockhart's in the house. Good to have you, Pam. I want to make more money like a millionaire. I do read watching video about mindset and rich people so I can learn from them. I appreciate that. And dad. What? Yeah, but James Lee, you're right. Yeah, reading is very important, but you got to put into work. Okay, don't overanalyze. Go ahead and actually start getting your thing going. So congratulations to you on that, James Lee. Do I invest in REITs? I think I own one ETF that it has some REITs and REIT stuff in it. No, I don't typically buy REITs though. No, nothing wrong with REITs. Real estate investment trusts are cool if you want to do that. Typically, REITs, especially in the commercial, they have lower returns than I want to play with, but they're not. If you get a good solid REIT, it's good for the long term. Nothing wrong with it. I'm okay with it. I don't have a whole bunch, just have an ETF. I'm 35, but already preparing for retirement now. Brad, what are you talking about? Brad said, I'm 35, but already preparing for retirement now before it's too late. Brad, you are 100% on the ball. Congratulations to you, Brad. If you really up it, Brad, and become really fanatical about this thing, Brad, you could probably retire when you're 50, 55, and chill out when everybody else your age has to work hard. Congratulations to you, Brad. Let's see here. REITs are down because of high interest rates. Yeah, the whole commercial real estate industry is down. How do you personally factor real estate into your investment plan versus stock market? I know you have a real estate too. So I wonder how you decide what to put back into rentals. I put most of my rental property money back into my rentals. Okay. Because I have they're not older, but both of my rentals were built back in the 50s and 60s. So I try to put all of my rental money back into my rentals. And so I keep that separate. Any money of course, I have a 403B through my job where I invest in as well, but also I have some outside investments as well. So the outside investments is typically done through, these outside side hustles that I do. So how do I factor in? I try to keep the real estate money with the real estate. Okay. And things go wrong in real estate all the time. One of the most important things you got to always have when you have real estate is you got to have money. People, listen, real estate investors that have no money or landlords that have no money, a lot of times those are the ones that you see that, when you drive out a property and it's all torn up and ripped up. A lot of times there's a landlord, but the landlord either doesn't care or doesn't have money, one or the other, right? They don't care about taking care of the property or they don't have the money to take care of the property. You'd be surprised at how many landlords don't have money, right? But so I believe in making sure that I put the money back into my properties as opposed to doing a whole lot of investing with those properties, right? Because things always go wrong on a property. You always got to have 500 bucks, 2,000 bucks, 3,000 bucks. I suggest about $5,000 per property per door at least. Right? If you want to go 10,000 per door at least, that's cool. That's a nice slush fund or whatever you want to call it, fund, emergency fund, whatever you want to call it for your rental properties. So that's kind of how I kind of manage all that, right? Keep the money from real estate back into real estate. Question: do you have a preferred time of day to invest in your ETFs? No, not at all. I don't have a preferred time. ETFs are not doing this large fluctuation in prices. Yeah, though they'll change prices throughout the day from $242 per share to $237 per share, but I buy for the long term. So since I buy for the long term, I don't trip on price fluctuations throughout a day, a trading day. Good question, Patrick. Let's see. Feds are going to cut rates. Yeah, the Feds are going to cut rates here. I don't think they'll cut them in July. I think they have a meeting at the end of July. I think they'll cut them in September. And I think they may cut them again at the end of the year as well. I think at least 2 rate cuts are coming. Question: I have a large IRA with my bank and I want to fire my advisor and self-direct my account. So I'm nervous about doing this. Every time I look at my portfolio, it's so overwhelming. Before you fire your advisor at your bank, you need to go ahead and make sure you understand and know what you want to do and why you want to do it. Okay. Don't just get rid of them. Check on the fees. What are you paying them? And don't be afraid to pull the trigger once you make sure you know what you want to do, why you want to do it. You have your goals set out, and now you can go ahead and do it yourself, right? Totally understandable. Blue butterfly flight. Don't be nervous doing it, but understand and have your stuff together, your P's and Q's, your I's dotted and T's crossed before you get rid of them. Now, what do you say to people that say if you don't hold it, you don't own it? They can't take your investment away. I'm not sure what you mean by that, karate chick. You might want to ask that differently. My landlord has money. Yeah, yeah. Some do, some don't. Does it cost a lot of money to keep up with maintenance of a rental property? We got some rental property questions. Yes, it costs a lot of money to keep up with maintenance on rental properties. When it comes to rental properties, and I don't do a lot of stuff about rental properties, I got 100 videos on rental properties on this channel on YouTube. You can always check those out under a playlist called rental properties and landlording, right? But yes, it costs a nice amount of money to keep up with properties and maintain a property. And you have to be able to do some preventive maintenance on properties as well, right? So that you don't just come in after the fact, show up every time there's a problem. Maybe you do some things ahead of time, right? Good question. What if the Feds never decrease rates again? They will. Don't worry about that. Somebody said, I hate financial advisors. I don't hate them. The financial advisors serve a purpose. But for most of us who don't have $5 million worth of net worth, we probably don't need them at this point. So listen, I appreciate you guys being here. Those are 10 of the common investing mistakes and how to avoid them. Again, don't forget, my partner on this video is Mint Mobile. Check them out below, guys. They are the premium, one of the premium wireless service companies on the planet. Solid 5G network, excellent customer service. You can keep your own phone number, right? And they're inexpensive. Check them out when you can. There's a link to Mint Mobile in the description box below. Also below in the description box on YouTube, there's a link to my schedule. Click it, jump on the schedule. I do one-on-ones helping people with their money. I don't have a course. I'm not trying to sell you anything. If you want to have a conversation, great. If you don't, no big deal. Just keep watching the videos. You can go over to our other website, our other membership site, if you want to get more behind the scenes of this channel, more behind the scenes of individual stock market investing, looking at what my strategy is, what my goals are, what my risk tolerance and all that good stuff is. We have done only a few videos over there so far because we're just ramping it up as we get more and more people over there. You can also check out 24 Laws of Money, a free ebook that's in the description box below. And just check out my website, smartmoneybro.com. Go over there and mill around, see what's over there and all that good stuff. So I appreciate you guys being here. You guys have been super duper valuable in this chat. Thank you so much for keeping the chat flowing and helping each other out. And I think I got rid of somebody earlier. I had to toss them out, had to 86 them, right? Got them out of there. I appreciate you guys being here. I'm going to jump back on tomorrow because I want to dig in tomorrow I'm gonna share. I'm gonna be a little more transparent tomorrow when I go live at 1 p.m. Central Standard Time, and I'm gonna talk about the errors that I made when it comes to investing. And I've talked about a couple of them sort of, but I'm gonna be more specific tomorrow at 1 p.m. Central Standard Time. So join me for that, guys. I appreciate you being here, Alvira, Mrs. Moore, Brad, the Walla Mala, John, Miss Reynolds, Pistol Pete, James, Karate Chick, Six Speed. I can keep going on and on and on again, right? Precious Love, appreciate you as well. Listen, as I always say, guys, share the video. Share it with somebody who's new. I know it's a long video, an hour and a half, but guess what? When you're trying to learn something as important and as valuable about your money, sometimes you got to get more than an eight-minute clip, right? Sometimes you got to get more than a 12-minute clip. Hey, as I always say, the best person who's going to take care of the old you is the young you. Guys, take good care of yourself and take care of other people. Until the next video, peace.